The central banks will be forced into this, the playbook. Now, there's so much uncertainty in the world today as prices of everything from energy, food, and assets have been spiraling out of control as inflation rages all around the world. The central banks and the Federal Reserve have been focused on bringing inflation down, and they're telling us there's an economic crash coming as they're prepared to crush the economy and the markets just to bring inflation down and act like they have some control. But what they're saying and what they're doing are different things. And what they want to do and what they're able to do, they're also different. So in this video, I'm going to break down some of the big uncertainties we're facing, what I think is coming that will force the hand of the central banks. We're going to take a jump back in history to explore the playbook to invest through these markets. And I'm going to give you 4 lessons learned and how you can use them to invest, build, and protect your wealth while most people get crushed by inflation and the falling economy as all this plays out. So let's go. All right, welcome back, my awakened lions, the one who see the world as it is and are willing to do the work in order to succeed. Now, something I learned early on in my investing career is there's no such thing as good and bad timing. There's good and bad strategy. So what that means is, regardless of what's going on in the world, in the markets, in the economy, as long as you change or have the right strategy for that time, you're going to do okay. So we're going to take a look at that today. All right, so first thing, of course, we'll frame it up a little bit. Uncertainty ahead. What's going to happen? Well, of course, we don't really know. There's a lot of uncertainty, it seems, but I'm going to clarify that for you, okay? So hang on. Are we going to go into inflation? Has inflation peaked? Did the Fed succeed? Is the 9.1 we had last month the highest? Are we going to go back down? Will we go into hyperinflation? Well, or could we go into deflation as they crush the markets? Hyperinflation, deflation. Is oil going to continue trending up? Energy continue trending up? Are we going to see $200 barrel oil? Or are we going to see $50 barrel oil? Will they crush the demand enough where the price comes back down? Is war bad? Will war be bad? Will war with Russia and Ukraine, will war with Taiwan, China, World War III, will that be bad for the markets and the economy? Or, like the war on COVID, will it be good, right? The markets and the economy never did better in that period. Will the Fed hike? Will they continue hiking? Will they hike 6 more times? Will they hike all the way through 2023? Or will the Fed pivot and blow the markets back up? Well, let's go ahead and dig into this and take a look. Now, I've talked about before, I made a video saying that asking if inflation has peaked is asking the wrong question. As a matter of fact, I believe that this might be some of the lowest inflation we'll see for the decade. Now, that doesn't mean that we, remember, nothing goes up in a straight line. So it goes like this. So we might have periods of disinflation, but I expect that we'll have continued inflation. And the reason why is because of the decentralized revolution I talk about on a regular basis. And what we're seeing is we have what's called secular markets. And when secular markets reverse, so a secular market is a long-term market. So since like 2008 to 2022, the S&P 500 has been basically going straight up. That's a long-term secular market. Now within that, we've had many dips, and those are called cyclical downturns. And what we've seen is the long-term secular trend of globalization. We've taken $50,000 jobs in the US, shipped them overseas for $8,000. We've taken $100 parts, made them for $8 overseas. And so we've seen this happening over long term. At the same time, we've had this giant monetary expansion, and we've had massive population increase. And so we've had a long-term secular market which has caused deflation, caused prices to come back down. But now that's reversing, and we're going to have a secular downturn in the market where we're going to have depopulation growth, not because of any sinister agenda, just because all the developed world's populations have gotten too old, the demographic cliff. I've talked about this extensively. If you want a video on that, go ahead and leave me a comment down below. So we have depopulation. We have, instead of monetary expansion, we have monetary decline. The central banks won't be able to continue to print as much money. And we're going to have deglobalization, depopulation, and monetary decline. Now, as that happens, that's going to cause inflation to go up. I made a video about it here. We'll go ahead and link it up above if you want to watch that whole video where I said I think asking if inflation has peaked is the wrong question. Now, the one thing to understand is that nations or countries that have money printers don't go bust. They can't go bust because they have a money printer. This is a key piece to understand. Do you think central banks will print more money in the future or less? Well, the answer is, do you think they're going to default on their debt? And the answer is no, and so they're going to continue to print money. Again, go back and watch that video. We'll link it at the end as well. Now, but what's important to understand is that this is a process and not an event, all right? So this is a process that we're going to see play out over a period of time. Don't worry, I'm going to break it all down for you. I'm going to give you the playbook, but I'm just setting this up for you. It's not an event. Everybody asks me, Mark, when is it going to happen? It's like, it is. It's happening now, and you have to understand it's a process, not an event. And again, like I said, go back and watch that video to understand that. But first thing I want to do is let's take a trip back in history. I know you guys love this. Let's take a trip back in history so we can see exactly how this has played out before and how we would have navigated it. So let's go. All right, so here we are back in history, I guess. We're all the way back to 1987, and we are in Zimbabwe. We're in Africa. Now, it's important to understand that Zimbabwe in Africa is it's supposedly a pretty great country. I've never actually been there. It's a beautiful climate. It averages between like 65 and 85 degrees. They had massive agriculture there. It's known as the breadbasket of Africa. They exported all this food out to the rest of Africa. But in 1987, it was taken over by Robert Mugabe, and he became a dictator, all right? And he wasn't a good dictator, he was a bad one, at least as far as regulations and policies. And he put all kinds of insane regulations into place. He really cramped down on the economy and prevented the economy from growing. He launched a bunch of expensive wars. Sound familiar? And so wars are very expensive. They take a lot of resources and they take a lot of money. He went and confiscated all the private land. So again, it's a beautiful climate. They exported food, so they had all these farms, privately owned farms. He went and confiscated them and gave them to his buddies, sort of like what happened in Venezuela as well. And so insane regulations, crazy money printing to fight expensive wars, confiscated private land, and they went from the breadbasket to a net importer. So when they confiscated all the private land that was being worked privately, and it was very productive, and it created massive exports, which created lots of money coming in the country, when they confiscated it, gave it to his buddies, then nobody knew how to grow anymore. They didn't produce any food, and now instead of actually exporting food and bringing money in, they became a net importer. It was horrible. By 2000, so from 87 to 2000, half the country was unemployed. So a great country with great exports and a great economy, and then within 13 years, half the country was unemployed. Now, that's only part of the story. What happened to the money? And this is the key that we need to pay attention to, because this is the playbook for us to follow through with. So the printer go brr, right? We love this meme right here where the central banks just print out money, just pump out money. And what we see is that in 2001, retail prices of goods doubled. They printed so much money, you had more money chasing the same or less goods, which pushed the prices up, prices doubled. By 2003, 2 years later, inflation was over 600%, which sounds big, but you ain't seen nothing yet. By 2006, just 3 years later, inflation was now over 1,200%, which is insane. By 2008, 2 years later, inflation was somewhere between 500 billion%, and I don't even know what this number is, 89 sextillion%. It looks like this. I don't even know what that number is, 89 sextillion. Now, to put this into maybe a little bit easier context for you to understand, let's take a look at this. We had the year 2000, the exchange rate was 1 Zimbabwe dollar for 1 US dollar. That was in 83. By 97, it was 10 Zimbabwe dollars for one. By the year 2000, after half the country was unemployed, we saw it become 100 to 1. By 2002, 2 years later, it became 1,000 to 1. By 2005, 10,000 to 1, 100,000 to 1. And by 2006, just 6 years later, it was more than 500,000 to 1. Now, it got so bad that they had to chop a bunch of zeros off and create a new currency. That was Zimbabwe dollar 1. Now we have Zimbabwe dollar number 2. And what we can see here is we have 2005, it was 650 to 1. I'm just going to fast forward. We have 2007. So we started 2007 here at 4,800 to 1. And then by December of 2007, it was 4 million. So it went from 4,000 to 4 million to 1. And then we go down, we'll just jump forward to July 2008, and I don't even know what this number is. So high, 758 trillion to 1. All right, and then, well, that failed. Let's chop a bunch of zeros off and let's try it again. And so we got Zimbabwe number 3. If we don't succeed, let's just try again. So we have August of 2008, it was 1,780 to 1. That was in August. By December of 2008, August 2008 to December of 2008, it was 13 quadrillion to 1. Sort of seems like printing all that money is a big problem. Now, what we can see here, just to kind of put this into some relation, here was it was 350 billion Zimbabwe dollars to buy one egg. $350 billion to buy one egg. Everyone was a billionaire, but they couldn't afford anything. That's a very key piece. We're going to get back into that in a minute. Just because you're a billionaire doesn't mean you're rich. Now, what happens, of course, as I always like to say, we get smacked by reality, right? Politicians can do all kinds of crazy things, but at the end of the day, there's natural law. There's reality that we have to listen to. So by 2009, after trying 3 times, after all that massive inflation, the government finally capitulated. They finally said, fine, all right, fine. We obviously can't manage our own currency, so we won't even have one. And from 2009 to 2016, the country of Zimbabwe didn't have a currency. They used dollars, they used whatever other currencies that people wanted to use at that time. But after a couple years off, by 2016, they said, we're a sovereign nation. We should probably have our own money. So they issued some bond notes. That's how it started. Debt. Let's raise a little bit of money. We'll issue some bonds. Look, we've been good for a few years, right? Maybe people will loan us money, and of course they did. You can see these Reserve Bank of Zimbabwe, these new notes that came out, and they had the bond notes by 2018. 2 years later, they said, let's just create our own currency again, right? But this time, we're going to do it really good. We're going to be really good with it. They promised to have restraint, right? Now, I hope you're realizing by now, it's not about getting different people to manage the money. It's not about getting better people to manage the money. It's about nobody managing the money because, of course, nobody can have restraint, but they promised to. But what restraint did they actually have? When they launched their currency, again, it was 1-to-1 with the dollar, pegged 1-to-1, okay? Then it went 25-to-1. Then in 2022, in January of 2022, this year, it was 108-to-1. And now today, it's over 500-to-1. That's how quickly they lost restraint. You can see it in a chart right here. It's gradually, right? Then suddenly. That's how it works. You can see right here, 500. This was March of 2019. That's how quickly their restraint faded. Now, again, when you have a money printer, you won't default. But you have to keep in mind there's 2 types of crashes or defaults. There's an inflationary bust, and there's a deflationary bust. Most people think there's only a deflationary bust, but there's also an inflationary bust. Now, inflation versus deflation. This is the question that everybody's asking. I think if you go back and watch that video or watch it at the end, we've made the case very strong that I expect there to be massive inflation in front of us. And I'm not going to go back into all the reasons why, but we've basically seen, as I said earlier, 4 decades of deflation as we ship jobs overseas, as we had parts made overseas that brought the cost of things down, all right? As we've had this global trade, as we've globalized that. But now that's all falling apart. We're going from a singular polar world to a multipolar world. The Russia-Ukraine conflict, the Japan conflict, the Taiwan, the China conflict, now the BRICS nations are breaking apart. Half the people in the world now form their new financial system. And so as the world continues to break apart, the US is now onshoring these jobs. We're setting up our microchip manufacturing facilities here. We're starting to mine back in the United States again. All of those things will bring the prices of things back up again. So like I said, go back and watch that video. Inflation has not peaked. I'll link it at the end of this video to understand the context of that. And remember, it's a process, not an event. So let's break this down and show you how it goes. Oh, and again, history. This book right here, I recommend everyone to read this book, The Economics of Inflation. You can find it at Mises.org, and you can download it for free, or you can buy it from him if you want the physical book. But read this book. This one and When Money Dies are two great books that document. When Money Dies documents the Weimar Republic. And if you really want to understand how this process works out, go back and read these books. But I'm going to break it down for you and give you the lessons right now. Okay, so if you really want to understand inflation, you have to understand, go back and do the research of these different areas that have done it, like I said, so start with that book. Now, what we can see is a couple things. So here's the Zimbabwe market. What we can see is that even with bad markets, there's times when things still go up. Because remember, there's an inflationary bust and a deflationary bust. So even though things are bad, doesn't mean prices can't still go up. Now, this is the Zimbabwe market. What we can see is from like 2014, we had about a 50% drop in the markets right here. And then they turned around and went up about 87 times right here. So you have these periods of market. So at this time, if you were zoomed in, you would go, well, if you zoomed out, you'd go, man, if I would have bought assets here and I would have held them to here, look how much money I would have made. But the problem is if you're looking very close and you're zoomed in on a very short time frame, all these periods of volatility shake you out here, shake you out here, shake you out here, shake you out here. So you have to zoom out to see what's going to happen. You have to have this long-term time perspective. Now, another thing to keep in mind, this is Germany. So Germany's Weimar Republic had the same thing. And this is the value of the German mark priced in gold. And again, if you would have just traded out of the currency here and bought gold, and you would have held it all the way to here, that would have been the trade of the decade. This is over about 6 or 7 years. But the thing I want to draw to your attention is as good as and easy as that trade looks, if you were to zoom in, you would see overlaid with periods of volatility. And so even though it looked like it basically went straight up, which it did if you're zoomed out, if you're zoomed in, this is all the volatility. And you would have gotten shaken out here. Oh, it's crashing, I should sell. Oh, it's crashing, I should sell. It's crashing, I should sell. It's crashing, it's crashing, it's crashing, it's crashing. So you have to understand these periods get very, very volatile, and you have to stay zoomed out. Okay, now the other thing we have to keep in mind is that central banks, they'll never raise rates enough. So the question is, will the Fed continue raising rates 6 times? Will they go through 2023? It doesn't matter. They're not raising rates enough. Inflation right now, 8.5%. That's what they state, even though everything has gone up way more than that, right? So they'll never give you the true inflation, first of all. Second of all, they'll never raise rates. They're going to raise them to 3%. They're going to raise them to 4%. But inflation is 8 or 9%. They're never going to raise them enough. So we have to be prepared for volatile shakeouts. We know that even in bad markets, prices can still rise, and the central banks will never do the hard work they need to because they can't crush the markets. The people will not stand for that. All right, let's dig in a little bit more. How do we invest through this? What can we learn from these books and these certain periods in Zimbabwe or in Germany? Well, again, we have to have long time frames. I believe my base case is that we will see more inflation moving forward. The central banks will have to continue printing money, and they're going to be printing money in an inflationary time. Inflationary because depopulation going down and deglobalization going down, re-onshoring those jobs, prices go up, and then the central banks will still be forced to print in that environment, which is going to be doubly bad. So that is the long view, in my opinion, similar to Zimbabwe, similar to Germany. However, if you zoomed in, it could be very volatile. So have a long time frame. The next thing you have to understand is that inflation kicks in earnings growth, all right? So as prices go up, companies look like they're actually making more money even though they're not. Again, let's jump in and understand from history. Here's Zimbabwe. So this is Delta Corp in Zimbabwe, a company in Zimbabwe. It's a beer company. And this is the 2020 annual earnings statement. So the 2020 annual earnings statements for Delta, which is a beer manufacturer. And it says, things are terrible in Zimbabwe. There's limited power. There's no job growth. There's no new industries. Sounds pretty bad, right? And the currency is hyperinflating. Wow, things are horrible, right? And of course, people still drink beer, but it says here that how much beer they consume per month or year is unchanging. So as bad as the economy is, no growth, no jobs, hyperinflation, people are drinking beer, but they haven't increased the amount of beer they're drinking. But what it says here is that, and yet, even though they're not selling more beer, and yet Delta earnings are up 700% year over year. How can Delta's earnings go up 700% if no one's drinking any more beer? Well, the answer is it's all inflation. But so is everything. So the price of the beer is going higher and higher and higher, so then the revenue goes higher and higher and higher as well. It's a very key piece to understand. Remember, just because prices are going up doesn't mean the value is increasing. It means that the dollar or the currency unit is losing value. So even though the company didn't get more profitable or make more money or create more value, because of the inflation, it looked like they were. And this is important to understand when you're looking at the markets. So we're going to see massive inflation still coming through the economy. We're just seeing it in the commodity sector. Now we're seeing it in the manufacturing sector. Higher energy prices, higher transportation costs, higher employment costs, and then they'll have to raise their prices. And as they sell their goods at those new higher prices, it's going to look like their revenue numbers are up. Most people aren't prepared or expected to see that. Now, we also have to keep in mind, I showed you obviously Germany, I showed you Weimar Republic, I showed you Zimbabwe beer, but let's take a look at some other things. This is the Turkish Lira. So when your currency is losing value because they're debasing it, they're printing more money, it's losing value. We made the case on that. Here's the Turkish Lira to the dollar. The Turkish Lira has been losing massive value to the dollar. As a matter of fact, it's lost 81%. This is 5 years, all right? So it's lost 81% over 5 years. Now, during this 5 years, it actually went up by 40% here. It went up by almost 18% here. It went up by 25% here. So again, if you were in Turkish Lira, you're holding Turkish Lira, and you knew that your Turkish Lira was going to lose value to the dollar, what should you have done? Well, you probably should have sold the Lira and bought dollars, right? Because you were going to lose 85% of your purchasing power in just 5 years. Trade of the decade, right? Or trade 5 years, half a decade. However, if you're zoomed in and you're looking at very small, here when it popped up by 40%, you probably would have gotten shaken out of your position. When it popped up 18%, when it popped up 25%, you probably would have gotten shaken out of your position unless you're zooming out. So what should you do? Get rid of the Lira, buy the dollar, okay? Now, what might be even better is to borrow money in liras and then use that leverage to make even more money. Now let's break this down a little bit more, because this also happens in dollars. Now, if we compare dollars to other assets, it looks like the dollar is getting stronger. I'm sorry, if we look at the dollar compared to other currencies, it looks like the dollar is getting stronger, which it is. But what about other assets denominated in dollars? So what we can see right here, in the same time frame, the same 5 years, the S&P 500 has gone up by 67%, or said another way, the dollar's lost 67% of its purchasing power as measured by the S&P 500. Okay, but Mark, that's just stocks, right? Okay, well, let's look at it another asset. Here we have the Case-Shiller Index, so this is homes. So what we can see is in the same 5-year period since 2018, we can see that the dollar has lost 58% to the average home. Now it gets worse. Since January of 2020, in the last 2 years, it's lost almost 50%. The dollar has lost almost 50% of its purchasing power in homes. So it's lost purchasing power in stocks, it's lost purchasing power in homes as well. So a couple things that we want to do. One, we want to be able to keep our money mobile. So if I was locked in Zimbabwe and I owned all that farmland and then they came and seized all my farmland, I lost all my money. Now, in those times, if I'm in Turkish liras and I want to get out into dollars, they're going to impose capital controls. They're going to make it very difficult for me to get my money out into another currency. And so you want to think about being able to keep your money mobile. So I'm buying assets in other countries. Yes, I have a lot of real estate in the United States. I don't see them coming and seizing that from me right now or anytime on the horizon anytime soon, but I'm still buying real estate in other countries. I'm also buying other assets in other countries, and of course, Bitcoin is the most mobile asset. I can take that anywhere in the world. We also want to think about carefully leveraging our assets. Remember, if I was holding Turkish Lira and I knew it was going to devalue against the dollar, I should get out of the Lira and I should buy the dollar. I might even want to borrow in Liras and then put that into dollars to use some leverage. So we want to use leverage against some of our assets. Now, if you're buying real estate with a loan, you're leveraging that asset. Now, what we might see is because what's really happening is the price of the home is going up even though it's not going up in value. It's the currency unit is going down. So even though the home may not be going up, the loan is being paid back, and what you're really doing is you're shorting dollars. It's basically the same thing. So in a hyperinflation environment, or not even hyper, just in an inflationary environment like the one that we're in, like the one that I believe we're going to continue to go in, the goal would be to carefully leverage assets without getting liquidated, because remember, we're going to have massive periods of volatility. So that's what I expect to happen. That's my base case. Check out that video where I break down why I think the central banks will continue to print money and why I think inflation has not peaked. And then let me know what you think. Leave me a comment down below. Of course, as always, give me a thumbs up on this video if you like. Don't like it, you can give me a thumbs down, that's okay, but at least leave me a comment. Hit that subscribe button while you're at it. And before you go, make sure you understand why I think inflation has not peaked. So go watch that video right here. And that's what I got for today. All right, to your success. I'm out.